Good afternoon, ladies and gentlemen. I'm Hussein Alawi, the Chief Executive of Frontier Exchange and the organizer of the forthcoming Nigeria Finance Conference and Exhibition. Together with our partners, Core International, who are the developers of the iMine portal, it gives us great pleasure to welcome you to this webinar today, which is aptly entitled The Current and Future Economic Outlook of Nigeria. Our distinguished panel today includes truly an outstanding lineup of speakers and is headed by Dr. Sarah Alade, the Special Advisor to His Excellency the President on Finance and the Economy. I understand Dr. Alade is rather pressed for time, so we'll start the session today by delivering a keynote speech. Thank you very much, Dr. Alade, and to all the team at the Ministry of Finance, Budget and Planning for supporting the session today. The session today is being chaired by Mr. Shola Olubi, who is the Head of Specialized Markets and Capital Markets Origination at Union Bank of Nigeria. So as we're all aware, the global pandemic has rendered meetings and conferences impossible during the current climate, yet still very important to keep in touch with each other and of course continue to showcase the commercial and business opportunities in Nigeria. This webinar today is part of a forthcoming series of webinars and digital initiatives that will draw attention to Nigeria's excellent investment and economic potential that we will be organizing over the weeks to come. I'm also delighted to announce that together with the Nigerian Investment Promotion Commission, we'll be organizing the Nigeria Finance online conference between the 24th and the 26th of November. I believe it's the first time that an event like that will be organized for Nigeria virtually, and we'll be updating you all about that over the days to come. And of course, we hope that all our distinguished panel today will join us as keynote speakers for that conference as well in November. So without further ado, it's really my pleasure to welcome Mr. Shola, who will be moderating our session today. Do please give him and our panel a virtual round of applause, and many thanks indeed for joining us here today.
Yeah, thank you, Hussein. Good afternoon, ladies and gentlemen. I am your moderator today. I am Shola Olubi. I'm the current head of specialized markets and capital markets origination at Union Bank of Nigeria, PLC. I have about 25 years work experience in the financial services industry, working with institutions such as Citibank, IFC, and Anderson Consulting, now known as Accenture. In my current role at Union Bank, I'm responsible for managing client relationships in power, telecoms, infrastructure, real estate division, and maritime, as well as raising long-term capital for the bank's corporate clients. Union Bank is one of Nigeria's longest standing and most respected financial institutions, offering a portfolio of banking services to individual, SME, commercial, and corporate clients. Our vision is to be Nigeria's most reliable and trusted banking partner. Kindly join me as we welcome Dr. Sarah Alade to give the keynote address. Thank you.
Thank you very much, Shola, and thank you to all the panelists. It is a pleasure to be delivering this keynote address on today's webinar session organized by Frontier Exchange on the current and future outlook of the Nigerian economy. On behalf of the Honorable Minister of Finance, Budget and National Planning, I would like to thank the organizing team for putting this together and for the kind invitation to join you on this occasion. As we all know, the socio-economic landscape of Nigeria experienced a severe shock in the form of a health and economic crisis as a result of the COVID-19 pandemic. And like many other oil-dependent economies, Nigeria was hit hard by the dual reality of the drop in crude oil prices and the effects of the pandemic. As a result, the fiscal outlook for 2020 changed fundamentally, with our revenues and foreign exchange earnings declining significantly. In addition to this, the implementation of a nationwide lockdown and social distancing measures led to disruption of businesses and significantly lower levels of economic activity, with many people either experiencing a loss of income and/or a drop in household purchasing power. By half year 2020, GDP estimates published by National Bureau of Statistics in August 2020 showed that Nigeria's GDP declined by minus 6.1% year on year in real terms, and in the second quarter of 2020, ending the 3-year trend of low but consistently improving positive real growth rates recorded since the 2016-2017 recession. It is worth noting that while the overall decline of minus 6.1% for quarter 2 and minus 2.18% for quarter 1 was unfavorable, it is better than the anticipated forecast of minus 7.24% as estimated by MBS earlier, and also appears muted compared to the outcomes in several other countries. As a response to the economic challenges posed by COVID-19, the federal government's priority has been to ward off a deep recession to save jobs through stimulus measures, to support local businesses, to accelerate healthcare interventions, and to enhance social investment measures to ensure that most vulnerable in our society are protected. On the fiscal side, several measures were implemented to respond to changes in the fiscal outlook, including, but are not limited to, a robust financing mechanism designed to raise revenue to support humanitarian assistance on the federal and subnational level through establishment of a 500 billion COVID-19 Crisis Intervention Fund for the upgrade and improvement of health facilities, waivers on IDEC and VAT exemption on identified medical supplies, products and equipment, and enhanced support to states focused on critical healthcare expenditure, and also to augment Federal Account Allocation Committee disbursements. The 2020 budget and the 2020 to 2022 medium-term expenditure framework, the fiscal strategy paper, were also amended, as well as the recently submitted 2021 to 2023 MTEF, which involved higher levels of foreign borrowing on concessional terms to supplement the imminent decline in oil and non-oil revenues. As a critical and deliberate measure, the Federal Ministry of Finance, Budget and National Planning ensured that the funding for capital expenditure was retained and has already released 50% of capital votes for all federal MDAs with targeted funds to cash back priority capital projects. These expenditures will yield increased capacity and productivity and thus ensure an economic benefit to the Nigerian economy in the medium to long term. To complement the fiscal interventions, the Central Bank of Nigeria introduced a suite of interventions, including the 50 billion household and SME COVID-19 targeted credit facility, of which 49 billion has been disbursed to small businesses and to over 80,000 households as of June 2020. 100 billion credit supports intervention for the health sector and has proactively motivated banks and other financial institutions in the country to introduce different initiatives, including waivers on payment of fees on credit cards, loan repayment holidays, to name a few. This, alongside other monetary policy interventions implemented in response to the pandemic during the second quarter, including moratorium on loans, credit support to household and industries, regulatory forbearance, and targeted lending and guarantee programs through NASAL, are some of the measures introduced to cushion the economic and social effects of the pandemic, and is expected to effectively contribute to dampening the severity of the pandemic on growth figures. Given the fiscal and monetary constraints, development finance institutions have played a crucial role by providing emergency financing to government from the concessional lending windows, and have thus supported government's capacity in meeting its obligations. Partnerships are critical to our success, and we must continue to collaborate and work together across all tiers of government, MDAs, the private sector, development partners, and other critical stakeholders to achieve coordinated action, policy response, and alignment of purpose. Ease of doing business plays a crucial role in the economic growth of any country. Hence, the recently passed Amendment of Companies and Allied Matters, the CAMA, in August 2020, will lead to significant reform of the business environment by reducing bureaucratic red tape and encouraging investments that will allow businesses to thrive, allow costs and ease regulatory burdens, thereby making the process of business operations easier and seamless. Other initiatives, including the visa on arrival policy, robust electronic registration and payment system, seamless processing of business registration, and reduction of cost of registering business by 50%, will continue to ensure that our efforts will result in further growth and recovery. The government has already introduced appropriate counter-cyclical fiscal policies, such as the recent reduction of corporate tax rates from 30% to 20% for medium-sized enterprises, as well as the complete exemption of MSMEs from corporate taxation under the Finance Act of 2019. It is expected that this will provide the necessary relief to allow small businesses to grow and expand their operations, thereby improving ease of doing business and affording them the opportunity to employ more and create jobs needed to stimulate the economy. As the economy gradually recovers, fiscal policy measures will focus on increasing revenues as well as expanding the tax base over the medium to long term to rebuild fiscal buffers and service the increased sovereign debt levels the government has been compelled to assume as an immediate response to the low revenue challenges. Hence, the federal government is committed to prioritizing job creation, economic growth enhancement, and socio-economic development. Nevertheless, higher levels of tax revenues will be required to sustain public spending, fund investments in critical physical infrastructure and human capital, as well as to service sovereign debt obligations. However, a holistic approach will be taken in terms of ensuring alignment and coordination with fiscal, monetary, and trade policies going forward. In addition, with the accession by various African economies to the African Continental Free Trade Agreement, there's need to be mindful of the impacts that COVID-19 will have on global trade and commerce in the medium to long term as free movement of goods, people, and services will occur. It is for this reason that the Honorable Minister of Finance, Budget and National Planning recently constituted the Fiscal Policy Reform Committee to ensure that the Finance Act for 2021 strikes a balance between broader macroeconomic strategies to attract investments, grow the economy, create jobs, as well as the implementation of fiscal strategies for accelerated domestic revenue mobilization in response to the COVID-19 pandemic and the recent global economic downturn. If the COVID-19 pandemic persists beyond 2020, it will fundamentally change how global, regional, and domestic commerce is transacted going forward. Hence, more focus will be placed on investing in ICT infrastructure, science, technology, engineering, the arts and mathematics, education, mobile money and financial inclusion, high-tech manufacturing and integration into global value chains, etc. And nations who do not do so, who do not invest, will see less, who invest will see less disruption as they transit from recession to recovery. Those that have not prioritized these investments may inevitably experience lower recoveries, remain locked into low growth trajectories, or regress from recession to depression. The COVID-19 crisis has created an opportunity for us to reset and prepare our country for the fourth industrial revolution, which is already here. In effect, we must take advantage of the technological change to thrive in and also survive in the coming era. We must design policy with this technological future in mind and be able to embrace it and its benefits. In response to the pandemic, ladies and gentlemen, and to avert and mitigate the effects of a deep recession, the Economic Sustainability Plan will be implemented to boost domestic value addition, de-risk the business environment, encourage external investment and sources of funding while rationalizing existing debt obligations and providing support to both the state governments and business sectors negatively impacted by the COVID-19 pandemic. The Economic Sustainability Plan is a short to medium-term structured response to the COVID pandemic and economic challenges. However, more comprehensive structural reforms will be fully articulated in the medium-term National Development Plans 2021 to 2025 and 2026 to 2030, and the long-term National Development Plan tagged Nigerian Agenda 2050. In the short to medium term, the federal government will place emphasis on the following measures: accelerating key structural reforms, including the recent exit from the fuel subsidy regime through the price modulation and the power subsidy regime, with a commitment to full cost reflective power tariffs in 2021. Accelerating civil service reforms, restructuring and reforming of key state-owned enterprises and government-owned enterprises, tightening and enhancing the coordination of fiscal, monetary, and trade policies. Reforming tax expenditures and incentive policies to optimize value for money and phase out inefficient incentives. Addressing lingering fiscal federalism and sustainability issues at the sub-national level. Deepening the ease of doing business and policy procurement reforms, and leveraging on private sector funding in key sectors to complement, enhance, or even completely substitute for some of our inadequate public expenditure. In closing, I would like to reiterate that despite the setbacks arising from the effects of the pandemic, the Nigerian government is steadily working to chart a path of growth and development for the Nigerian economy by improving productivity in several sectors and creating opportunities for growth. Once again, I thank you very much for the opportunity to be here with you today, and I look forward to a very fruitful session and stimulating exchange of views. Thank you.
Thank you, Dr. Aladi, for your very, very comprehensive keynote address. We'll wait till later in the session where other people may want to ask you some specific questions. But I'd like to move on to Yasmin Rahman, who is the country director for the IMF in Nigeria, who would also be making a presentation. You may please go ahead, Jasmine.
Thank you, Shole. Good afternoon. I'm in Washington, D.C., so I was going to say good morning, but it's actually good afternoon. It's nice to be here. Let me share my screen. Okay, good. So I'm going to talk about the COVID-19 impact and outlook for Nigerian economy. Let me start by stepping back a little bit. So how did it look before the crisis came? So pre-COVID-19 fundamentals for Nigerian economy were not that strong. So if we look at growth and inflation, real GDP growth rate was around 2%. Now that growth rate was firmly below the population growth rate. And if we compare Nigeria to emerging and developing economies, the average for this group, growth was half of what it used to, what was experienced by this broader peer group. In terms of inflation, average inflation in the last 3 years before the crisis were on average 12%. That's 3 times as high as the inflation rate in the same peer group. So in terms of macro fundamentals, we had a situation where per capita income, real income was growing, was declining, and at the same time, cost of living was increasing. Let's look a little bit in terms of FX inflows. So here you can see, broadly speaking, the sources of foreign exchange flows for the Nigerian economy. And roughly half or more of it comes from one source only, which is oil and gas. So we had a pretty undiversified and concentrated source of foreign exchange for the economy. So that's sort of the context which, before the crisis. And then we had the pandemic. So the pandemic hit Nigeria very hard in Q1. The first chart, you can see here what happened on 3 things. So crude oil prices dropped by about 80% in the first quarter from their January level or end December level. And at the same time, the stock of foreign holdings, capital holdings, dropped down by 40%. And risk perception of Nigerian government as captured by the CDS spread went from 400 basis points to 1200. So all these things happened at the same time. There was shock on the financial access front, shock on the oil price, and shock on capital outflows. The right-hand side chart, that sort of tells you what happened on the real economy. So Dr. Alade talked about Q2 growth. You can see here that the economy contracted by 6%. This is actually better than we had expected. We were expecting an even sharper growth, but that 6% is a very large contraction too. And most of it happened on the non-oil, non-agricultural sector. Now it's important to mention that the oil is capturing simply the oil production. The non-oil, non-agricultural economy depends very heavily on oil price development. So that's where we're seeing the transmission of low oil prices, in the economy, in addition to the COVID-19 pandemic-related close down, which was necessary, to protect on the health side. So that's sort of the economic impact of the pandemic. Maybe we look a little bit on the impact on the poor. So I would like to talk about food inflation, which was already high in Nigeria even before the crisis, and that has been creeping up. The latest observation shows it's at 16%. Now that's happening all over sub-Saharan Africa, but not, the level is not as high as, let's say, the median or average sub-Saharan African countries. So that's a clear impact on the poor. On the unemployment, again, the rates were already high, but has shot up even more. So if we take both unemployment and underemployment, roughly half of the labor force is either unemployed or underemployed. And if you look at the youth population, the rates are much higher. So in other words, there is a strong negative economic impact, financial impact, but the impact on the vulnerable and poor are even worse. So let me now move to our outlook. For 2020, we are projecting a contraction of a little over 4% in real GDP. And the contraction is happening in both oil sector and non-oil, non-agricultural sector, while agriculture is expected to grow, around 1.7%, right, a little below 2%. And the dynamics and drivers similar to what has happened in Q2. Basically, it is the non-oil, non-agricultural sector that's taking the biggest hit, both because of the close down and also low oil prices. Moving on to recovery, we are projecting a very protracted recovery. So in our baseline projection, real GDP level is projected to go back to its 2019, i.e. the pre-crisis level in 2022. So that's a horizon of 3 years. And this is roughly what happened after the last commodity price shock. It took the economy about 3 years to go back to the pre-crisis level. This time around, the shock is, the repercussions are even broader because it's not just a commodity shock, it's a pandemic as well. So naturally, even these very gloomy projections have large downside risks. And those risks are coming because we simply don't know the path, the outlook for the pandemic. There are second waves in various parts of the world. The first chart here shows you, new COVID-19 cases in thousands, 7-day moving average. The blue line is advanced economies. In sub-Saharan Africa, we haven't, it's yet to play out, so to say. Africa started late and testing is low. So we simply don't know. We haven't seen the whole of it, so to say, the pandemic. So all of these uncertainties have implications for not just the infection rate, close down, etc., but also global recovery, which in Nigeria's case could have another, return in oil prices. So there's just too much, there are a lot of uncertainties in terms of the recovery and outlook. So let me now talk about a couple of policy challenges. Dr. Alade gave you a very, nice overview of what the government is doing, both from the fiscal policy side and monetary policy side. So I will just, our sense is that it is a fiscal situation with, low revenues, etc., and the government is doing its best, to cushion the impact of the pandemic. But as we go towards, as we get into this very, sharp contraction, protracted recovery, large downside risks going forward, there are sort of two challenges that Nigerian authorities will face. One is on the fiscal side. So the first chart here shows you how much the interest payments are as a ratio of federal government's revenue. Now that ratio this year, according to our latest projection, is around 84%. And in the medium term, it's projected to stay quite elevated. If you express that ratio in terms of consolidated fiscal revenues, it will be lower, but it's important to remember that it is the federal government, that pays the interest payments. So what that tells you is a large chunk of, fiscal revenues are sort of tied up for debt service payments. So that restricts government's ability to do other things, including, if the pandemic related health spending needs to go up, that's going to be a constraint. So the government ability to help the economy is sort of structurally constrained by very low levels of revenues. And that we see kind of continuing because, as you know, measures to increase revenues, whether we are talking about tax administrations, whether we are talking about tax policy, as long as compliance is low, to have the sort of dividend, the fiscal revenue dividend, it takes a long time for that to come into stream. So this constraint is likely to stay alive in the near term. And a second policy challenge is on the foreign exchange part. So the first chart here shows you what's happening in the INE window, which is the main sort of market, foreign exchange window in Nigeria. If you look at before the crisis, the turnover was in the range of 200 to 400 million per month. Since then, since April, we have seen that turnover drop to below 50 million per month. And that's happening reflecting two things. Private sector who has the foreign exchange are not bringing that supply to this window because of uncertainties. And private businesses want to access that, for debt service payments or buying raw materials, what have you, for various business needs, are not able to buy. So you have a severe, there's a big mismatch between demand and supply. And that's spilling over on the price side. So the second chart shows you what's happening on the parallel market rate. So in March, the parallel market rate was very close to the rate in this I&E window. But since then, you have a big divergence as some of this demand is spilling over in the parallel market rate. So the result of this shortage has been that affecting business continuity of private sector, creating a lot of uncertainties, devaluation fears, and just in general affecting business environment. So this is another policy challenge that the government will have to tackle as oil prices continue to recover. Let me now move to talk about what the IMF has been doing to support economies worldwide and in Nigeria because of this crisis. So we have significantly ramped up our emergency aid. Lending so far to the continent, all of Africa, is about year to date, just in 2020, is roughly 27 billion. And a good chunk of that is coming through our two emergency financing facilities, the Rapid Financing Facility and the Rapid Credit Facility. So that's about 18 billion just year to date. Now, to give you a perspective, if you look at what has been our average annual disbursement to the continent of Africa in the last 2-3 years, that's roughly 4 billion. So already this year, the amount that we have dispersed is, multiples of, more than 4 times of what we used to do. So it just tells you, that the severity of the crisis has really generated a very, very strong response from the IMF. Now, in terms of our help to Nigeria, Dr. Alade mentioned that, we dispersed 3.4 billion, which is 100% of Nigeria's quota in the IMF in April as our under the rapid financing instrument. This is a no conditionality emergency aid, which is dispersed to countries which are facing exogenous shocks, large shocks. It could be pandemic, it could be earthquake, it could be other natural disasters. And this instrument, together with this sister instrument, which is RCF, the RCF and RFI, RCF is just for very low income countries. These two emergency facilities are designed, they're different from our regular programs. There are no conditionality because they're emergency aid. They're really there to support the economies as they need it in real time. So the quick disbursements, typically in one tranche. But there are important policy commitments. In the case of Nigeria, I have here in the slide, there are policy commitments for exchange rate unification, greater flexibility, domestic revenue mobilization, as Dr. Alade was talking about, and commitment for transparent use of emergency funds. So I'll stop there and maybe pick up something in the Q&A session. Over to you. Thank you.
Thank you very much, Yasmin, for your very insightful presentation. And it was also well-balanced, very well-balanced presentation. Now, I'll move on to Ebrima and Charles. I don't know if you'd like to share a few words or if you'd like us to go directly to the Q&A section.
Hi, so thank you very much. Maybe I can just, not much to add to what Sarah and Jasmine mentioned, but I would just like to share a couple of perspectives very briefly, if that's okay, before we jump to the Q&A. Similar to the two presentations, we see the near-term economic outlook for Nigeria as somewhat bleak, arising from the two negative shocks, both the pandemic and, of course, the falling oil prices. And it's also compounded, of course, as already been said, by the less favorable domestic and international financing options. The medium-term prospects are actually not promising either. We see growth averaging just over 1% at the most over the next few years, while inflation will remain in double digits. So aside from the need to define an agenda of structural reforms to boost the country's potential, this outlook also raises doubts regarding the suitability of perhaps the overall macroeconomic policy framework and its impact on policy level. We are very concerned from where we sit with the weak public investment alongside the limited foreign direct investment, of course, arising from this. And this is likely to contribute and has contributed, it's likely to contribute to a return in to a second recession in really, a span of 4 years. So this will, of course, force the government in the current environment to cut down on physical investment in physical infrastructure, with the attendant impact of course, reducing long-term growth. The other aspect of lower capital investment, of course, aside from the growth path, which I think if you look at the slide that Yasmin showed, that trajectory has actually completely moved away from what we were talking about in the ARGP. So I just wanted to flag that, and we will certainly also want to point out that we have been working, of course, with the ministry, who are indeed great supporters of the bank, but also the bank is heavily involved with Nigeria. We are supporting the current crisis with budget support, and also formulating parallel programs in the sectors to help to support the Nigerian government withstand this COVID shock. The COVID shock is really a shock to the real economy, both to demand and supply. Of course, it's external. One thing that also the bank is quite concerned about is the absence of a comprehensive social safety net system in Nigeria. And because of that, it has placed an enormous amount of responsibility for avoiding mass employment on the individual business owners, who have tried, I think, to keep as many of their staff as possible. But of course, it's not sustainable. If they start making losses, they will not be doing that. So the government is challenged to do more to get relief and cash to those who need it most. It's a huge challenge facing the government, and one that of course they are struggling with. The dilemma is that it of course fits into the deficit that we're already talking about, and then makes it worse. Yeah, I'm happy to stop here, and then be happy to take some questions after Charles's presentation.
Okay, thank you very much, Charles, for those comments. Thank you very much. Ibrima, would you like to share a few words, or do you want us to go right to the question and answer session?
If I could just jump in with a few words.
Okay.
Unfortunately, I can't be much more optimistic about the economic outlook than the views already expressed. But I would like to say just a few points. Firstly, what Dr. Alade has talked about the Ministry of Finance doing, I think has been a big deal. The fuel subsidy has sat there as a kind of a chain around the neck of the Nigerian fiscal situation. Every time the oil price went up, that fuel subsidy kind of stopped the full benefits coming through to Nigeria because it was so costly, and it wasn't going into the investment into infrastructure or education that the country's really needed. So I think the fuel subsidy removal has been good news. The suggestion that electricity prices will be allowed to reflect cost in 2021, really good news. No country industrializes without electricity, on our numbers, being 300 kilowatt hours per person. Nigeria is less than half that. And the reason there's not enough electricity in the country is because it's not profitable to make it. So it's really important that the price is reflecting cost. So these, I think, are really positive reforms that we're seeing happen. The difficulty for the foreign investor, and as the token European on the panel, I'll speak for those foreign investors sitting in New York and London and elsewhere. The difficulty, and it hasn't been mentioned yet because we haven't got the central bank representation, but is the FX policy. 2015 to 17, foreign investors couldn't easily get their money out of that, certainly portfolio investors couldn't easily get the money out of the country. And that same problem has come about again. And foreign investors are learning a lesson here, which is if they invest in Nigeria, they can't be confident about being able to get the money back in, out. And so they don't then want to put it in. So I've got a client of mine who has faced redemptions from his investors. His investors have given him money, said, go and invest in Frontier. He's put a chunk into Nigeria. That original investor is now wanting the money out, and the fund manager I'm talking to can't take it out of Nigeria. Yeah. So now he can't meet the redemption request that he's getting from his clients in the States. So the lesson he's learning is Nigeria has to be off my radar screen from now on, whatever the potential is for the country. And I think this is the biggest challenge, unfortunately, for foreign investors. But I also think it's a problem for Nigeria's growth story. There's a shortage of savings in the country. And you can address that by having a cheap currency and a current account surplus. You could also address that by attracting in foreign direct investors or foreign portfolio investors. But you're not going to attract those in if they're not sure they can take the money out. And so we've got a problematic situation here where there's not enough local capital to invest and to meet all of Nigeria's needs, but foreign capital is not being attracted by the currency policies we're seeing at the moment. I have to say there is good news, even on that, and I'll just finish here, but there is good news. And the fact that the central bank has the government's official rate has gone from 306 out to about 380 is really helpful. Really good for the budget, much more sustainable. It's a huge improvement, but still not enough liquidity in the market for foreign portfolio investors.
Okay, thank you very much, Charles. And I'm going to come back to you with regards to the outlook for the foreign exchange market. But I'd like to put a question to you right now. With regards to the structural reforms that we've seen, the removal of the fuel subsidy, the convergence of the FX markets, the adjustments of electricity tariffs to make them cost reflective, would you say Nigeria is at a point of no return towards becoming a free market?
I've always felt Nigeria's very free market. In fact, it's one of the most free marketplaces in the world because the government's role is so small in the economy. And I draw a huge contrast between, say, what's happening in Nigeria and Ethiopia, which has been growing very well for 10 years, but growing in a really Stalinist way. If you go back to how the Soviet Union developed in the 20s and 30s under Stalin, he basically just took the savings of the country, everybody's savings, and pushed it into the areas of investment that Soviet Russia felt was necessary. And Ethiopia does a little bit of that too. You can't go and save your money anywhere you like if you're in Ethiopia. You can't take your money out of Ethiopia. You'd struggle to buy a car in Ethiopia. So there's not an awful lot you can do with your money, and the government then lends it out at less than the rate of inflation, your money. And that is a very, very non-free market story. And any profits that accrue in the telecom sector is taken by the government as well. So that's a huge contrast to what happens in Nigeria. And the free market aspect of what's happening in Nigeria should be good for the country in many ways. And telecoms prices, for example, I think is a part of that. Telecom service, much better in Nigeria than Ethiopia. And I think that comes about because of that free market competition that you just don't have in Ethiopia. So yes, I think it's a free market story.
Okay, thanks. I'll be coming back to you on the FX situation. Ibrima, would you like to share any words, or do we go right straight to the question and answer session? And you're currently on mute, Ibrima. Okay.
Yeah, sorry, Sola. The transformation was not so good. I missed your question.
Oh no, so I said, would you like to share a few comments, or would you like us to go straight to the question and answer session?
Yeah, no, I thought I did share some initial remarks.
Also, okay. So okay, we're fine with those. We will proceed to the question and answer session. Okay. I'd like to first have my first question addressed to Dr. Alade. You spoke on the several interventions the government has implemented to address the impact of COVID. What type of recovery should we expect to see in Nigeria? From what Jasmine said, it seemed more like an L shape where we would see sustained stagnation. She actually said for about 3 years before we expect to see recovery. Are you more optimistic in that you see maybe a V recovery, or maybe then a U-shaped recovery?
Thank you, Shola. I think we need figures to be able to say this is what we see. But I want to say something. When Jasmine was making her presentation, I believe the projection is based on where we are today. The constraints we have in fiscal policy, the constraints from the foreign exchange. She already mentioned some of those things, and I agree with her. If these things, if policies continue the way they are today, we probably see a protracted kind of recession. And then the recovery is not likely to be quick. But I believe, and the basis for the optimism is that things are going to change. And I just mentioned to you some of the things. This time last year, or even early in the year, no one believed that the government was going to have the will to remove the subsidies, which they did. And I just mentioned in the keynote address that hopefully by 2021, we are going to have a cost-reflective tariff in that area. So if policies do not continue, these policies, things are not the way they are today, then there's no way we can have a protracted kind of recovery from the things. I believe it's going to be better. And I believe I already mentioned the kind of that we're having a committee on fiscal policy reform. Some of those issues we haven't done. We're talking about tax expenditures. We are talking about leakages, blocking leakages. We're talking about making government-owned enterprises responsive, bringing in just to be able to increase the domestic revenue that we are trying to do. We're trying to expand the tax nets. Yes, while you are giving some, tax waivers, we are also saying that those who should be paying taxes should be within the net. And there are so many things we're trying to implement at the same time. Some of these things cannot be done as a big bang. You wake up one day and, who is utopia? We have all the policies in place and so on. But I think you have to give credit to the government for doing these things. We are, and the basis for that optimism, like I said, that the COVID-19, the recovery from the recession, one is that I believe that the recession will not be as deep as is projected. And then it's not likely to last for that long because of all the actions that we're likely to take. Even I also mentioned the coordination between monetary policy, fiscal policy, as well as trade. I did mention things about ease of doing business. We're looking at all these fronts. What are those things that are preventing the foreign investor from coming in? What are those things that are even discouraging the local investors from investing money? These are all issues that we will take. And I believe that by the time these policies are in place, then recovery will be faster than Jasmine and Ebrima than they are projecting, and will be there. So that's the basis for the optimism.
Okay, thank you very much. Thank you very much, Dr.
Shirley, if I may just add a clarification. So the growth scenario the chart that you saw is in real GDP level, right? So the recovery, the economy is projected to start having positive growth beginning next year. It's just that the real GDP level will not come back up to the pre-crisis level until 2022. So that's a clarification. The second point is I want to stress what Dr. Alade just mentioned. It is really, encouraging to see that the government has removed the fuel subsidies, and if the full cost recovery in the power tariff, SOE reforms, procurement reforms, business regulations, all the set of things that she talked about happens, and also equally important that Nigeria opens up in terms of trade. It does not serve Nigeria well to be such a closed economy, given its gravitas, the role that it can play in Africa, globally, that the closeness really doesn't work in Nigeria's favor. So if all that were to happen, of course, the growth trajectory that we are projecting under baseline, roughly 2.5 or so, can take off significantly.
Thank you very much, Jasmine. Okay, so I'd like to address this to both Jasmine and Ibrahima. I'm sure your responses may be similar, so whoever takes the question will be satisfied with one response. The IMF and the AFDB, they've approved considerable amounts of money to several African countries, including Nigeria. Jasmine, you even actually showed a slide. To the extent that you can share with us, what mechanisms do you have in place to ensure responsible spending and proper utilization of COVID intervention funds?
Okay, I can comment on that. The budget support, as Jasmine, unlike the funds funding this time around, it's not a normal case, as Jasmine mentioned, do have some conditions precedent to disbursement that we have discussed and agreed with the government. Those are basically triggers as to what we would like to see done with that money. Of course, in this case, it included issues around testing. How do you scale that up much more than the level it was? Provision of certain medical supplies and social safety nets to the general population. Built into that are fiduciary safeguards, including, of course, frequent quarterly reporting, how the money is disbursed to the government accounts, audits, etc. So there are really some many fiduciary safeguards that give us, and also give the government, because the government has taken some really credible steps in setting up the different accounts and how those will be monitored. So I think together we are very conscious of the need to make sure that funds are directed where they should be.
Okay, thank you very much.
Can I just ask one question? Is it possible that you could lend some money to the UK government so we could sort out testing in the UK and we stop buying ridiculous masks from Turkey that don't work? It'd be really helpful. I'd like some conditions, please.
Okay, only the fund can do that. So Jasmine, over to you.
Yeah, you wish, right? Maybe to answer the question you asked about what sort of mechanisms are in place to ensure proper use. So from the fund side, all of these emergency lendings, RFI, RCFs, the country authorities are making commitments to ensure transparent planning, transparent use, monitoring, and reporting of COVID-19 related spending. So, they need to be transparent in terms of the procurement, etc. And once the spending is done, there is also commitment to do auditing. And several countries have already enacted legislation and established oversight bodies to implement the enhanced governance measures. So, for example, Burkina Faso, Central African Republic, Gambia, etc. I wouldn't necessarily say that we are, following this as a conditionality, but we are discussing this with the authorities as a follow-up. These were the commitments, what has been done, so that's where we are. And it is absolutely important that the money is used transparently.
Thank you very much, Jasmine. Dr. Alade, I have two questions for you. The first is that we're currently seeing in Europe a potential second wave. How is the government prepared to face the second wave if it reaches Nigeria, if we experience this in Nigeria? Are we prepared for this?
Yeah, we are. It's one of the things we're discussing. I mean, that it's on the table in the with the government. I'm not in the PTF, and I'm not a health expert, so I would know. But if there is a second wave, definitely the government is prepared for it. It's a possibility. We know it's a possibility that there could be, and we are ready for it, at least from this side. So it's only those the health personnel and other and the PTF that could tell you in terms of the health issues and concerns what they are doing. But in terms of the fiscal possibility of having to support if there's a second wave, the government is ready for it.
Okay, so very quickly, I think we're about to close. I will just quickly take a question from Charles. Charles, I mean, we've witnessed what seems to be a reversal in the use of monetary policy to address inflation and manage the exchange rate in Nigeria. Just a few days ago, we saw the MPR, the monetary policy rate, reduced from 12.5 to 11.5%. And while this is positive for lending rates and economic growth, there are implications for the Naira with regards to the low liquidity levels we are witnessing. In terms of specific numbers, in Q1 2020, from FPIs, from foreign portfolio investments, we saw an inflow of $4.3 billion. This reduced to only $385 million in Q2 2020. What steps do you think the Nigerian government has to do to, address this foreign exchange problem, which has been historical and which they've tried to adopt all kinds of measures to manage to manage the currency? And like you said, until this is addressed, then FDIs, FPIs, and capital importation will always be a problem. If you can quickly address this, and then I'll take some closing words from all the panelists.
I mean, foreign investors got used to there being more than one rate. And if the INE window, the importer and exporter window, had allowed to be floating and to reflect supply and demand, that would have been enough, actually, to keep investors still feeling comfortable. Everyone knows they might take an FX loss when they invest in a country. It's when you can't get the FX at all to get out is when they get really upset. So even if that had been allowed to fluctuate, it didn't need to be unified. It is better for it to be unified. It would be better if the central bank was prepared to give us money dollars to meet demand and to then find the exchange rate which they feel comfortable about matching supply and demand. But yeah, the difficulty is just not having access to dollars at all. I did have one final question possibly for the IMF and Dr. Alade, which is that on the dollar side, this isn't a great problem. On the dollar debt side, it doesn't worry the investors too much where the FX rate is. But I am curious about if US Treasuries stay as low as they do, might Nigeria be refinancing more of its debt in the external markets? And what might the plans change on that if global interest rates stay as low as we think they might? So I'm just curious about kind of potential, the borrowing issuance plans for the next 2 to 3 years for Nigeria, because I think dollar bond borrowing rates are going to be very low.
I can start, and then maybe Dr. Alade can tell us what's actually happening. I can speculate. So for this year, actually, we think that much of the fiscal financing need will actually come from the domestic market because of the OMO policy, which prohibits the domestic non-bank sector to hold it. All the maturing MOMOs from their side is now finding its way into the government bond market. So the rates are really, really low, rock bottom, across maturity in the domestic market. So it would be strange not to take advantage of that. And I think the government has already started to take advantage of that by, raising the ceiling and also going for longer maturity in the domestic market. Going beyond, yes, you're absolutely right that, the world is flush with cash, and with the outlook, issuing bonds externally should not be a problem. But what matters is also at what cost, right? So the risk premium, etc. We expect that the government will be going into the market, international market next year. There is a Eurobond repayment falling due. And so getting the FX would be important. But I think it's still pretty high, the borrowing costs, and they will need to come down, more than it has since March. And it's critical what you mentioned about risk perception, about investor perception. There would need the uncertainties and the negative sentiment will need to come down significantly, I think, before any issuance at reasonable cost. That's my take.
Thank you. Okay. In your response, Ebrima, could you also speak on I don't know if there are any conditionalities, beyond the convergence of the FX markets to have a free floating exchange rates, which would improve the level of liquidity, because this is a really, really serious problem in the markets over the last few months. It's very low levels of illiquidity because, there's a significant, arbitrage between the parallel markets as well as the other FX markets.
So I think if it's okay, I'll let Jasmine take the questions on the forex markets, since they and the World Bank are doing more work on that. But I would like to, if it's okay, just to speak to a question that came earlier on the reforms that Dr. Alade mentioned about. We certainly welcome those. Clearly, very much excited about it, and we would like to know more about it. Some of them we already know about. But just to say that clearly there is space to improve efficiency, both in terms of getting more out of each naira spent, and designing tax systems and improving tax administration to raise revenues. We do believe that tax reforms, additional measures are needed to scale up mobilization of domestic resources, including expanding the tax base, particularly also given the informal economy, the informal sector, the large size of the informal sector. We are working on a couple of DRM papers that we would of course share with the general public for debate. We also believe that tough choices have to be made regarding expenditures, cost and rationalization. And again, we welcome the Fiscal Reform Committee that Dr. Alade that Dr. Alade spoke about. Cutting productive public investment will halt growth and therefore likely to jeopardize the government's medium-term efforts to reduce poverty levels. So it will be better to focus on streamlining government consumption, particularly on wages and salaries. Of course, Jasmine has already spoken about the large chunk of the revenue that's going to interest costs. And of course, that needs to be looked at again very carefully. We do believe also that there's space to improve the institutions to ensure perhaps more policy consistency and to avoid policy reversals. I think Dr. Alade mentioned a gradual approach to the adjustment, given the fact that it will take a little bit of time. In that case, I think the credibility of announced plans is key. While Nigeria has actually some very good policies in place or institutions in place, it may not be announcing or at least communicating these policies in a way that instills confidence in both consumer and investors. So we think these are areas that are low-hanging, and I think from what I can hear from Dr. Alade, they're moving in that direction. So just wanted to also point that out.
Thank you very much. As we close, I'd like to take closing remarks from the panelists, starting with Dr. Alade. So just as part of our closing.
Thank you. I think I can hear you, and all I want to say is that we are aware of those obstacles. Let me call them obstacles to investors. Charles is happy when those are removed, and we're working on them. We know that the economy, we're faced with challenges. We are working on overcoming these challenges. And what I want to leave with you is that all these, including policy reversals, the lack of communications, these are all things that we are addressing. And some of the institutions we're reforming, some of the things we are doing, that government has probably not been able to come out to say, so that people will know exactly what they are doing and how far we are going. I think that will also be taken on board. But the important thing is that we are aware, and the government is working on them, on policy reforms, so that things can be better than what Jasmine is projecting for Nigeria. Thank you.
Thank you very much, Dr. Alade. Jasmine, your closing remarks, please.
So Nigeria's population and natural endowments promise enormous potential. There's no doubt about that. But to materialize that potential, it needs to have higher investment, domestic and foreign, and it also needs to have high productivity. And for these two things to happen, increased investment and higher productivity growth, we need to have policy clarity, regulatory predictability, trade openness, and competitiveness. So crisis could reset things, and we hope it will, so that Nigeria can fundamentally change its growth path.
Thank you very much for those words, Jasmine. Ibrahima, do you have any additional closing remarks? I know you already shared a few. If you don't, I'll move on to Charles. But happy to hear you if you have any closing remarks.
My only closing remarks is whenever Nigeria has a woman in a position of power, good things happen. And I think Dr. Alade and the Finance Minister have done an amazing job this year. I think you know, Okonjo Iweala did a fantastic job when she had a very senior position, and I very much hope she can go on and lead the WTO and turn that into something even better as well. So that would be my concluding remarks. Thank God for Nigeria's women and men too, but women.
Okay, so I'd like to say a very big thank you to our panelists. I think we've had a very robust, very interactive session. From the comments coming through the chat, they've been positively received. There were several questions we couldn't ask, but we will try to see as many as we can communicate back to the questions that were asked. Some have also asked for the presentations. I don't know if these can be shared, but we will communicate to the participants after the session. Thank you very much for your time once again. Yeah, Hussein, I don't know if you'd like to.
Oh no, Hussein is not here. So thank you everyone for joining us today, and hope you register for our next event. And join me in sending out a virtual round of applause to our panelists. Thank you very much, and hope to see you soon. Bye.
Okay, thank you very much. Okay, bye.